Welcome to Your Money with Leo Daprile. I'm Leo Daprile, and each week on AM 570, Dan Rivers and I will talk about anything and everything to do with your money. If you ever have questions, please feel free to call me at 330-533-6936, or you can email me at leo@gemyoung.com. Enjoy the show.
This episode of Your Money with Leo Daprile is sponsored by Grange Insurance.
The segment is brought to you by Gem Young Wealth Advisors, and you'll find them on Star Center Drive in Canfield, and a family business that does business with individuals and families that need comprehensive risk management for their wealth and assets. We believe clients want professional advice at a fair value, and they deliver that by leveraging their reputation of professionalism, integrity, teamwork, and get it done right the first time attitude. And they believe in making a difference in their clients' lives. And if you want to call them, it's 330-533-6936. And with all the formalities out of the way, we welcome Leo Daprile. Hello, Leo.
Good morning, Dan. How are you today?
Pretty good. You know, I think I was just reflecting back on this. The first time that you and I had a conversation was when the insurance companies were offering a device to put into your children's car so you would know where they were. And that was many moons ago. And, of course, by now the phones have taken that role on themselves, haven't they?
Yeah, isn't that interesting? And I'm surprised that so many people are willing to put these devices in their car and on their phone and have them self-tracked. Because, you know, the way the insurance industry works, it's to me, Dan, that's always been sort of a gimmick, quite frankly, because your driving record tells what you do. Your credit tells you how responsible that you are. So there's been so many factors through the years where insurance companies have been able to line up and figure out what people should be paying for their insurance. And we always, you know, would ask you how many miles you drove a year anyhow. So these new commercials and these new techniques are really gimmicky to me because that information's been known and it's been utilized for probably 20 years.
So it's actually very predictive, right, by the models that they would have accumulated over the years. You know, if you live within 5 miles of work, your chances of having an accident are much less than someone that lives 10.
Remember, insurance companies are run by actuaries, and these are the people that are the math folks in the world, and they don't like surprises. So this is nothing new. This is just another way for them to just rise above the noise of all the constant automobile advertising that you have going on to show that they're doing something different. When in reality, they're really not, because they, you know, and you got to look at how they play the game. If they think you're going to end up getting a lower rate, they're not going to start you with a lower rate, right?
Mm-hmm.
It's just like this vanishing deductible that everybody promotes. You don't think that comes at a cost, so they have to raise the premium so that they can subsidize a low or no deductible product. So all these things, like I said, are gimmicky to get your attention and make it look like you're getting something more for your money, but you're not. You're paying for it.
So, I mean, it is really intriguing when someone says you can get your premiums back. But you're saying in the macro or in the global, the amount of accidents are relatively stable, right? I mean, they know the amount that they're going to have to pay out typically. I mean, unless there's an actual natural disaster.
What's interesting about that with car insurance, for instance, the number of accidents has actually declined through the years because of cars are better built. There's more technology in them. Not that the human behavior's changed. We've just made it safer for the human to be a human, if you will. But what has changed is the cost to repair these vehicles has gone up substantially. So actually, with a lot of insurance companies, the losses they're paying out on their auto side of the policy is actually increasing because the cost to repair that car is so much more than it was. I mean, go back to the days, Dan, when you know, you got in a wreck and you had that big steel bumper and that big steel front end, and they pulled some parts off, either, you know, bend them back or replaced them. Now, so many of the car products are composite material, and once those crack or break, rarely can they be fixed. Inside those plastic front bumpers are all these sensors and controls. You know, you have the front of cars now that have that energy absorption zone, so things break a lot easier. So there's much more damage that happens, even in a quote unquote fender bender, because of the way the cars are built today.
Yeah, I mean, it is something that you find out when you take your car over to the body shop. And Sandy's is one of the people that advertise with us, and I remember I was having a front grill put in my truck. I hit a wheelbarrow in the driveway like an idiot. I don't know why I didn't see it up there, but that little mistake up there, it caused the grill to break, and I saw the guy taking the grill apart, and I thought to myself, good Lord, how does this guy know how to assemble this? Had it all laid out, but you'd really have to go to school just to figure out how to put these things back together. And it kind of begs the question. You kind of wonder why the automobiles haven't come out like they're very modular and they just kind of snap, or they're kind of like a Lego set to put back together. That would be the ideal.
We might get to that.
Yeah,
we might get to that. Knowing them, they're probably working on it. But so let me say the first thing about your little accident in your driveway.
Yeah.
My official response to that is, if people didn't have accidents, we wouldn't have a business.
Yeah, that's very true. That's very true. And you think about those little things out there, you scratch your head and you wonder why, and you learn to drive carefully. One thing I've taken to doing is actually backing into the garage, because haven't you always worried about backing over a bicycle or backing into backing into your own car? That would be the worst, wouldn't it?
Well, it happens more than you know.
Yeah, you got it. All right, let's turn tables on you a little bit and refer to a Wall Street Journal article by Sam Goldfarb, and it talks about the average U.S. investment grade corporate bond is now yielding less than a key measure of investors. What's that all about? What's he mean by that?
Okay, this article caught my attention, and here's why it caught my attention. You hear me say all the time that markets advance when there's confidence, right? Mm-hmm. And I'm always looking at that and always looking at different indicators. So the way bonds work is, when people are fearful, they tend to go to bonds because they're more conservative. So when they do that, back to supply and demand, there's not an infinite supply of bonds. So what happens is the price of those bonds starts going up, okay, which can affect the yield or the income that buyer is going to earn. But when people start to have confidence, they're less interested in buying the bonds, so the bond prices go down and the yield will go up just a little bit, okay? So that's the offset of how that works. But
so
what's going on now is...
Just one question. You said a finite amount of bonds. I mean, that could grow, but it can't. It's not like it's unlimited, like stocks where you can continue to buy them. There's less bonds. Is that the idea?
Yeah, and if a company's not issuing bonds or looking to add debt to their portfolio,
right,
there just is an inventory to be purchased.
Okay. Got it. And so you drive those prices up in bad times.
Correct, because you're running from stocks, you're running to bonds. It's typically how it's played. But right now, with the interest rates being so low, less people are buying bonds because they're having more confidence that the companies that are issuing the bonds are going to be able to meet their debt obligations. So we've hit this point where the average, if you're a high-quality company and you're looking to borrow money today, according to this article, the average interest rate these companies are paying is 1.85% on their bonds. Okay, which is good news for the company. But if you're an investor and you're in an environment where the Federal Reserve's telling you that they want a 2% inflation rate, if we hit a 2% inflation rate, you're really not making any money on that bond, and you're actually stepping back a little bit.
Wow. So, and 1.85 would probably be for investment grade, right? I mean, this is not junk or anything like that.
That's correct. That's the investment grade bonds, and that's what their average of what they're borrowing money at. So what that does, Dan, is if you're an investor and you sit there and say, well, geez, company X over here has a 3% dividend, if you will, and I'm just making that for an example, but their bond's paying me 1.85%. If I have confidence that they're going to be able to meet their debt obligations and pay this bond, why would I buy the bond and why wouldn't I buy the stock and assume a little extra risk because I already believe they're going to do well?
Yeah. Now, dividends, different than bonds, do dividends actually, in this case, beat the yield? I mean, the dividends come out, they can come out every quarter, they can come out every month. Do they end up beating the 1.85?
Depends on the company. They can. Now, here's the difference. When you have a bond, the interest rate on the bond is a mandated payment. So if a company begins to stumble and it's not necessarily able to pay that dividend, then they can suspend their dividend, which many companies did during the pandemic to preserve cash, but they still have an obligation to pay the interest rate on their bonds. So that's one of the advantages of being a bondholder. It's more conservative. Mm-hmm. You're up the food chain in case there's a problem in terms of getting your money back.
Now,
that's the additional protections bonds give you. But right now, there's really no, with inflation, if we run a 2% inflation rate, you're really not being compensated for the risk you're taking.
So the one thing that you have the problem with is that people are not going to be using bonds, so the bond market is going to lag. Is that necessarily a problem for the economy?
No, actually, I think it's the reverse. It's showing you that a lot of people have a lot of confidence in the economy. They have a lot of confidence in the American companies, and that's why they're making choices other than bonds. So what people are doing now when they're buying bonds, it's basically buying a backstop to your portfolio against volatility to that portfolio. And you got to know that going in there, that if you're going to do that, you're going to earn very little money and have a very low rate of return if you have a very heavy bond-centric portfolio. But that's the price of being more conservative. And there's nothing wrong with that, as long as we're good with that, because there's a lot of investors and clients that I have that are risk-averse people. And there's nothing wrong with being risk-averse. You just got to know going into it, here's what my outcome's going to be.
I got it. All right. Very well. All right. That's Leo. And surprisingly, not everybody in our audience uses Leo as a financial advisor. I'm kind of surprised at that news. But so one of the things that you have, if you do have another advisor, one thing you go to them with that information and say, you know what, if you have me in bonds, I'm probably 0.15% below the true inflation rate, so I could actually be losing money if you have me in bonds. Would that be the knowledge you'd want to take to your advisor? I'm sure they will know it, though, right?
Yeah, I'm sure they know it, and I'm sure, but I think it's important to have the conversation by saying this is what the current landscape is. You may have done this 2 or 3 years ago, and if you're like me with most of my clients, we own individual bonds. We don't own bond mutual funds because we kind of graduate out of those and get into more sophisticated planning. So we're choosier. And one of the challenges we're having now is it's taking us months to actually invest in a bond portfolio because we're just trying to find the right quality bonds that are available because the inventory is so tight.
Mm-hmm. Okay. And then what about U.S. Treasuries? Do they play a role in this?
Oh, they're the indicator to all of this. And that's what's good about this. We're getting close back to a 1% interest on the 10-year Treasury notes, which is important because back in March, it was significant. The yield was significantly below that because everybody was afraid. And when everybody's afraid, they go buy treasuries, which bids the price up, which reduces the yield. Now they're starting to unwind those a little bit, which means treasuries are having to pay more because people are, again, it's back to being they're confident. They're wanting to do other things with their money. They have confidence in the economy. So there's more opportunity for the stock market to advance. That's how I'm reading into this. That's the data that I'm getting from this.
Let's talk a little bit about the current reality, and that's the feasibility of President-elect Joe Biden's plan for sweeping tax increases on people over $400,000. What do you think about that, Leo?
Well, the speculation's starting to come out, Dan. I know we kind of touched on this a few weeks ago, but it's starting to get more narrow in its focus. That's why I wanted to bring it up again. I think where this, like you've talked about, I think where this really hinges is what happens in the Senate come January determines the acceleration of tax increases. But my industry is already preparing for tax increases of some sort, so they're starting to bake those in to the planning process and the pricing. So one of the things they're thinking, though, is with the coronavirus, especially with the new administration coming, they're going to have their hands full with that. So nobody's expecting sweeping changes in 2021, especially if the Republicans hold the Senate. But they're saying it's coming, and some of them are going to be less noticeable to a lot of people. One of the big takeaways from this is on the estate tax, and that's always an interesting tax to me. And when you tax an estate, because the person's no longer around to defend themselves. Most people don't know about it, so it's easier to pass through Congress because it doesn't really affect anybody. Well, through the tax plan that we had, we went from paying tax on, 15 years ago, states that were worth more than $600,000. Now that number's up to $11 million per person, $22+ million for a husband and wife. So that sort of net worth is out of reach for 97% of Americans. But what they're looking to do is drop that back in half and increase the estate tax from 40% to 45%, which is crazy. If you think about it, you've spent your life working, and if you've been successful in the world, at your death, you can give up to 45% of your estate.
Boy, that is a hell of a number, isn't it? I mean, now that would be on people that have an estate worth more than $6 million?
They're talking about dropping it to around $6 million, right? Which that's not as uncommon today as you might think, especially with the way housing's appreciated. And it might not necessarily resonate with people in this market, but there's a lot of other regions around the country where you can build up a sizable estate where what we used to call asset rich and cash poor with your assets.
Yeah, I mean, if that happened, most people, if they inherited that money, they would have to sell the estate to pay the taxes, wouldn't they?
Yeah, that's going back to the old days of what we used to do. There was techniques we would use to fund that before. Many of those people would buy life insurance for the sole purpose of paying estate taxes.
Yeah.
You're just buying your dollars for pennies at that point.
Yeah. Is there any good reason to have an estate tax other than the government can?
I don't see one. I really don't, especially when somebody spends their lifetime accumulating and building an estate.
Yeah, I mean,
the 45% of it.
Not to interrupt you, but I mean, the thing about it is that you've paid taxes all along the way of building that estate, and now the government is going to come back and say, because you were successful, we're going to take half of it again. That seems patently unfair, doesn't it?
Always has to me, and I bring it up because, like I said, the people that it affects aren't around to fight for it.
Yeah. What happens with people that have an estate of $4 or $5 million? They wouldn't be affected by this at all. Is that correct?
That's correct. Right now, they won't be. But assuming that number doesn't drop lower, and I've heard talks of that number dropping even lower so that they can broaden their pool.
Yeah.
But this is current consensus.
Yeah, I mean, really, it's kind of hard. It's almost like a core belief. Most of us believe that a minimum wage is not necessary because the economy will provide a better wage because the folks out there that are hiring people, they want quality people, and they can't get them unless they pay $11 to $15 an hour, and maybe they even have to go higher. But the minimum wage is kind of an artificial thing. As would be the estate tax. I can't think of a good reason to have that. The third most likely would be the estate tax down. And what about the tax hikes with little chance of success out there? What do you think they are?
I think it's going to be tough to get a really broad tax increase. That's why I think what you're going to see is, because also with the Democrats lost so much more control of the House, that's going to change the landscape. And it'll be interesting to see how they hold on to that, because now it only takes a few detractors to try to get a deal done, which could ultimately cause more gridlock. So I think a broad, sweeping income tax is going to be hard to do. So I think you're going to see kind of a targeted approach where they're going to go after the wealthy, because everybody likes to say that's okay and continue to tax that. And to a degree, there should be some more taxes paid. So, and nobody's really fighting that. And more importantly, everybody seems like they've made peace with that.
Yeah.
I think you're going to see capital gains taxes increase, which is, again, that's a disincentive to how you invest, too, when you're starting to tax capital gains like ordinary income and dividends, which is one of the conversations that we're having.
All right. I've got to leave it there. And if you'd like to speak with Leo and maybe hire him as an advisor, he is a fee-based advisor. He'll give you the straight scoop. They're at 3792 Star Center Drive in Canfield. You can call them at 533-6936. And, Leo, what's your email?
It's leo@gemyoung.com.
Thanks for watching the video. Be sure to like, subscribe, and hit that little bell for notifications. And also make sure to connect with us on Twitter, Facebook, and LinkedIn. For all of your business news, visit businessjournaldaily.com. For all of your arts and entertainment news, go to afterhoursyoungstown.com.